Okay, well, this is all good information. So this is saying if you take every trade, 820, that's a lot of trades, of course, and held it for 20 days, you'd make $32,000.
Right.
And your initial equity over here on the right was $10,000 and $1,000 per trade down at the lower right-hand corner.
Initial equity 10,000.
Okay.
And the $1,000 per trade. Correct. The other useful stats that you can see if you go to this chart here, it shows you the statistical chart of how this strategy performed. And this takes a little bit to get your head around what's happening in this chart, but it is a very powerful view. And the way I explain it is normally there's a blue line down the center at 0%. You can see that right here. And anything that appears to the right of the blue line is a profit. It's a stock that made a profit. And the further away it is from the blue line, the higher profit it made. And so the numbers that you see above these green bars show you how many stocks were in that particular profit bucket. So let's take one, for example. This one here that shows 61. We'll come down to the x-axis here, and it's saying that 4%, that's between 3 and 4%, there were 61 stocks that made between 3 or 4% using this strategy over that time period. And what is interesting here is to see the shape of this curve. And you can see there is a lot. The shape is a little skewed to the profit side. So that might give you an indication that the strategy is actually quite good, because the shape is skewed out towards the higher, towards the positive percentage gains. The other useful thing is this chart is shown in combination with the chart below. And the chart below is showing you every single individual trade that was taken, and it's showing you the essentially one candle per trade. It will show you the open, and it's done in terms of percentage. So it will show you the opening percentage, which is in this case always 0, the high that the trade reached in terms of percentage, and the low that it reached, and then where it closed at. So that's a very interesting chart. And what's more with this one is that you can actually click through. If you find something that you think is a little out of the ordinary, you want to investigate further, you can double click on it, and you'll be taken right to the chart, and it will show you exactly what happened for that trade. You can see where the entry was. You can see the exit. You can see the reason that the trade exited, and that was because we have set in a hold period of 20 bars. And so you can visually see that this actually was a great trade. This was a fantastic trade.
Couldn't do any better.
But of course we were able to pick this one out because we were looking right at one of these tall green bars down here. You can also see from this top chart that there was one, that the biggest percentage gainer was this one stock here that made in the region of 35%. And you can always locate that by just scrolling through here. We'll see where that 35, let me get the 35% into view here. But what I can see right here is this, I can see the 34% stock right here. You see how I found that? And now I can click on this one and see what happened here. And again, great trade. All right, so.
Oh, that's good.
So that is the basic sort of views. So we've got the summary, the equity, this view, next M bars I call it, and then the trade list itself. But of course we're using number of days for holding, and this isn't always suitable. People are not very comfortable with holding for a set number of days. You want to have a better way of getting out of a stock, and this is where version 4 of the program really comes into its own. Let me show you.
Okay.
Yeah, so take a look at, well, first of all, you might want to have stop losses, right? I mean, you don't want to enter a trade without a stop, necessarily. So you might want to try seeing how the stops affect your trading. So you can use a protective stop. Let's say a fixed percentage stop, for example. And we'll say we don't want to ever lose more than 5%. Let's see how that affects this this chart. You see what's happened?
Well, it cuts your profits way down.
All right, and also look at the way this chart is now shaped. You have this huge number of stocks that ended up losing around 5%.
We're looking at the top 4 relative strength ETFs over this time period, right? And that's all this graph is
That's
showing.
correct. Yes. Okay, so you've
All right.
got these, and this is really showing you that you had a lot of stocks, 160 plus 157, that pretty much these are the ones that hit your protective stop. And you can verify that by going to the trade list here, and you can say, well, here's my exit reason. Let's group this by the exit reason, and we can see that there were 325 that exited because they hit the 5% loss. And here's the list of all those stocks.
So that's telling us that the stops are either too loose or too tight. I mean, it could
Right.
be either way, right?
Absolutely. I mean, generally, I think that it's true that whenever you add a protective stop in, it will protect your loss, but it will also limit your profit.
So let's make that just for the heck of it a 20% loss.
All right. Yeah.
Just which could be considered a disaster loss.
Okay. So we'll just bump this up to 20, and
20.
run this thing again.
Wow.
That
See?
actually improved your.
That profit and loss.
Yeah. In fact, we had nothing hit at 20% loss. there were no stocks that got to 20%.
So with a diversified portfolio, trading the top 4, that and a wide stop, at least in this market, would have been very profitable.
The interesting thing is, if you're doing the backtesting and you're trying to find a good place to put a stop, then you can look at this chart here and you can just say, well, look, nothing went below 17%. So maybe a good place for my stop would be down here at minus 6. Of course, there is going to be way more than 18 that hit minus 6. There may be even some that hit minus 20 because of the fact that they went there and then bounced back again. This is essentially showing you where they closed.
So let's change it to 10 quickly, and then we'll move on.
10. Okay, and run that.
Which is kind of a compromise here. Okay, well, it knocked it down some, but your average hold period only went down 1 day, I believe. Wasn't it 20 before?
It was.
Okay, now let's take this from a different angle. Let's use a fixed percentage gain.
Okay.
And let's say 5%. If you gain 5%, and then you just take the trade-off, let's see how that works out. Well, that's not too bad.
That's not too bad, and it's interesting to see down here. All of these bars are kind of shaved. They've had a bit of a shave and haircut right here at 5%. They could have gone a lot further.
Mm-hmm.
You see the shadows or the wicks on these candles. They did come down to because we've taken off our stop loss now. Okay, so they did lose. Some of them were losing minus 16, minus 20%, but they ended up being winners in the end because the profit stop